Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So on the EIA show today, we're going to look at what's happening on a global basis in the beginning, and really kind of summarizing what has happened in the U.S. so far this previous week, and what do we expect to happen on the upcoming few weeks, as we do have some decent weather conditions coming through. I should say some extreme weather conditions coming through the Northeast, but then things warm up a bit, which will help kind of soften some of the demand that we've seen on the diesel side. Still remains strong, but again, the Northeast is a big piece of where some of that demand is. On the differential front, looking abroad, things are staying fairly tight. There's a lot of that is due to the uncertainty with Russia. So we've seen some Euro cargoes moving through, some especially in Europe, as they're trying to hoard a bit ahead of what could be who knows. So it could be a very interesting next few weeks when we're looking between Russia and Ukraine, which we've been covering on the Econ show, and we continue to talk about. So those are going to be some of the things that we're going to look at, and then what is happening in China as we head into the Lunar New Year. So now, just turning to what has happened so far in the market. When we look abroad, you can see that total oil and product stocks, they dropped by about 10 million barrels. Most of that was driven based on products, and when you're looking at it in Asia, and we're going to go through this in some pieces. So when we look at total oil and products, you can see it was down. The deficit widened from 85 to 95. Total crude stocks, both land and floating, the deficit went from 29.4 to 35.2. And then when you look at total oil product stockpiles, they went from 55.7 to 60.2. So now breaking that into pieces, when we look at that total crude stocks, land and floating, remember there was a big shift from floating storage into crude in transit. So we did have some of that timing delay. We've now had an increase in floating storage for last week. And that's really just because that crude that went into transit or has been in transit is now starting to show up, and that's going to offset some of that. Now, the question is going to be, does it go, how long does it stay offshore? We still have a significant amount of supply chain issues, so we do expect that to remain elevated and keep things artificially low on the land storage side, as some of these tankers get stuck offshore. On the total oil product stockpiles, so you had some fairly large builds in Fujairah. Then we had some essentially flattish activity coming out of Singapore, some small builds. But then you had a pretty sizable draw coming from Europe. And we talked about this last week because the EIA show was recorded on Thursday. So because of that, we're not going to repeat the data in segment 3. So this is just giving you an idea of what has happened. So we have seen some of that reverse when you're looking, not so much on the Europe side, but when looking at Singapore, we're seeing some of those builds continue to grow, as well as Fujairah. So the oil product side, we don't see as bullish. We do see some of those builds coming through. Nothing crazy. When you look at where it is on that blue line, it's not like we're going to get this huge spike up, but fairly flattish as we go in. And then we're going to get to, because as you can see, the comps get a bit easier, we're going to come closer to the bottom of that cloud, as we see crude stocks, are below that 3-year average from 17 to 19, but you can see it's at the low end of the cloud, and we expect that to continue to just creep higher as it gets into the average. Now, when we look at some of the things that are shifting, 68 cargoes are due to load for Asia in January, which from West Africa, which equates to about 2 million barrels a day, and that's slightly below where we were in December. Some of the shipments have just been dropping. You had a decent move through, and now you've had some of that slowdown. When you look at some of the activity, just because some of the quotas have been met, the quotas have been fairly tight when you look at what has happened heading not only into 2022 for the new import quotas, but also due to the slowdown that's going to be driven based on the Olympics, some of the Omicron that has spread throughout China, but some areas are starting to normalize a bit. We are obviously going to Lunar New Year, so you will get more travel. But as we showed in either last week or the week before, some of that travel will be pared back versus normal. Now, when we shift into land storage, So when we look at weekly, so the deficit narrowed from 52.2 to 50.8. Again, just kind of some of the things that we were talking about, because land storage increased a bit, floating storage decreased. When you think back to the summary that we provided in the previous chart. West of Suez, the deficit narrowed from 39.7 to 39.4, fairly stable. There wasn't too much of a swing one way or the other. And just based on what we're seeing, we see just kind of a steady rise. And when you think of rise, you have to put it into context, because when you look at that cloud, we're still just below or starting to get into the bottom of the cloud. And to see builds at this point in time, if you look at that 3-year average, it's very normal. So the question is going to be, what is the rate of change? Because we expect the rate of change to pick up just a touch, which will put us a little bit closer, or I should say a little bit further into the bottom of that cloud. Now, when you look at land storage east of Suez, the deficit narrowed slightly from 29.9 to 28.2. And that's something that's going to continue as, again, based on the timing delay and where the movements are from offshore to onshore. And we should see some of that. But again, nothing is going to happen quickly just because of supply chain issues, delays because of Lunar New Year. Because remember, Lunar New Year is an Asian holiday, so that is just again going to slow down some of this east of Suez activity. On another front, just looking at Saudi Aramco, there's expectations that it's going to increase the price of Arab Light crude by 55 cents a barrel in March, going to Asia. The OSP differential is estimated to be at a $2.75 premium, which if you think about what February is $2.20. We'll talk about what the averages are as we get into Friday, just because we want to see what are some of the other capacity that is expected. Based on where differentials are right now, it would make sense to see a little bit of an increase, but it's also going to come down to where is Middle Eastern floating storage. It's been creeping higher, and are they going to try to keep that competitive? Are they going to try to move that through the system? So those are going to be some of the things that we're going to discuss a bit more in segment 3. We also have the OPEC meeting next week. We expect a rubber stamp 400,000 barrel a day increase. Nobody's hit it. So, just you could say it, but it doesn't mean that you're going to reach that level. And we actually have another rollback of loading schedules coming from West Africa. And a lot of that is in relation to, another increase in floating storage, which is starting to show some cracks on differentials. But it's really right now only really pegged into West Africa, because we're seeing some continued tightness in the Middle East. We'll talk about SOMO or Iraqi SOMO in segment 3. And then when you look at what's happening with Europe as well as a bit out of Asia. So now when we look at floating storage, when you surplus widen from 29.8 to 42, so we're starting to get some of that floating storage increasing. When you look at on the west of Suez, the deficit widened from 0.4 to 3.3. But when you look at east of Suez, that's where you had the biggest change from 36.4 to 49.9. And this is what we've been referring to when we're looking at what are some of the shifts doing, what are some of the impacts, and a lot of that is coming from just those cargoes showing up. We are still seeing some drawdowns from land storage, but again, there's more than enough to backfill into that. The question is always going to be how quickly do we see that movement? But we do have some more shipments showing up just based on what is happening in the market. They've been slow steaming, trying to time it, but again, these are things that are going to show up. So now when we look at what are some of the shifts in the U.S., because it's important to look at what's happening on the rig count side as well as the frac count side, as we've been talking about. And I thought this was a really good chart. Privates now comprise half of the Permian rig count, which isn't surprising when you think about the activity that we've seen. But it also opens up some opportunity where if we start to get a lot of the publics ramping up a bit, not obviously they haven't so far, but as you start getting through this year, when you start having the public starting to pick up activity, that's when you could start to see this accelerate. The question will be, are there available frac spreads to do the work? we expect to be at 275 fairly quickly. We were saying by the end of January or the first week or two of Feb, depending on weather. But that's getting close to kind of the peak amount of utilization. There's still a little bit of availability, but you're going to have to start seeing guys make deals, frac spreads starting to come to work, because some of that spare capacity that we're talking about, it's not like you snap your fingers and you come back. Some of that is going to need a new transmission, some new fluid ends. They've been ripped apart. They might have to be rebuilt, refurbished. So it's not going to just come right back. So the deals have to start now, get an increase in pricing, and start putting in those orders, or at least take delivery of the orders that were put in anticipation of these increases. So that leads us into where we are on crude stocks. So crude stock had a build. We had a build of 2.38 million. That's still 50.7 million below the 5-year average. And the draw was driven by Pad 2 and Cushing. Pad 2 had a draw of 1.43 million, bringing us 21.4 million below the 5-year average, and 1.82 million down in Cushing, which brings us 15 million below the 5-year average. Now, when you look at Pad 3 continues to have a build. That was a build of 2.36 million, and then Pad 5 had a bounce of 1.35. Pad 5 is fairly normal. Pad 4 is normal, and that we expect to see Pad 3 ramp up and start to see the builds increase there. Pad 2, the imports coming down from Canada still remain elevated. We expect that to remain the case as we head into turnaround season, which again is going to put a bit more crude in storage. But you can see that we're still fairly below where we normally are. And then Cushing had another drop. We should start to see this adjust. This is not something that I was expecting. I was expecting to see, again, a little bit of a draw, but something less than 1 million. And clearly we had another nice draw out of Cushing. So it's going to come back and forth between what is happening in Pad 3. We expect exports to remain lackluster, just given some of the pricing differentials, some of the pricing metrics, and that's going to be something to watch as we go through the remainder of this month and then obviously into next month. When you factor in draws from the SPR, the build was only about 1.13 million, and that's something that's going to continue based on what has been decided from Congress. When you look at the production estimate, there was a drop of about 100,000 barrels. And again, there's a lot of seasonality in that and weather when you think about just where things are, some of the impacts. So we expect to see, there's always going to be adjustments, here or there, but that's something that will bounce back fairly quickly. Now, when we look at runs continue to drop. We had a small drop of about 40 basis points, bringing us to about 87.7. And as we've been saying, the rate of decline was going to slow. So we're actually coming very close to where we are on that 29-year average, and we just expect it to hold the average. When you look at runs, Pad 2 still remains elevated, again, also maintaining some of that the draws from storage. It's 162,000 barrels a day above the 5-year average, while the rest of the nation is about anywhere from 200 to 400,000 barrels a day below normal, bringing us in aggregate 743,000 barrels a day of throughput below what is deemed normal. So, these are things that are going to be that are going to continue to be impactful, especially when you look at where are runs, where storage, and then what is the import-export situation looking like. Which is here when we look at imports, we were expecting to see a fairly stable import through from Pad 3. We expected to see some drop, but not to 474,000 barrels a day. There is some timing in that, so that's something that should get a makeup when we go through this week into next. So in total, there was a drop in imports of 510,000 barrels a day. That keeps us over 1 million barrels below the 5-year average. Pad 2 still remains well above the 5-year average. That's something that we are going to continue to see. Pad 3, obviously, as we said, had that big drop, and Pad 5 remains lumpy. Had a drop of 221,000 barrels a day, but still fairly in line with the 5-year average. And that's something that we expect to continue to increase, especially when you consider what is the target, which remains middle distillate, that diesel cut, as they try to minimize the amount of gasoline. And just to kind of putting that into perspective, so on the production side, gasoline production was down by about 1.19%, which is about 1.6% below the 5-year average. While when we look at distillate production was up 1%, approaching almost 31% of the run. So again, these are going to be some of the key things. That distillate cut still remains the bright spot, especially in the U.S. We're starting to see some headwinds in Singapore, but that's really driven based on some of how expensive crude has gotten when you look at the differentials, which is putting weight on that, as we do have some pretty steady demand from the middle distillate side in the Asian theater. When we look at implied demand in the U.S., we had another tick up in gasoline of 281,000 barrels a day, bringing us to about 8.5. This week, we expect a pretty sizable drop, and it's just because of how weak last week was and some of the weather that's going to come through at the end of this week. They're talking about it going to be a bomb cyclone / nor'easter. So the estimates keep changing. I've seen estimates from anywhere from 10 inches to about 27 inches, depending on where you are, where I am. So it'll be an interesting shift. But typically you get a little bit of a panic. People fill up ahead of time, and then they and then you get that big drop off. So again, that's going to keep things fairly depressed, because you are seeing some of that in last week. You'll see a little bit of a bump this week, and then you'll see that drop off as we go into the end of the end of January, and then again starting out fairly slow in Feb. So we do expect to see a sizable drop in the gasoline for that week. And just word of caution for those preparing, it is good to have a full tank of gas, not because you're going to run out of gas, but just making sure that there's as much weight as possible in the rear of the car. On the distillate side, another positive number, another increase of 198,000 barrels a day. That is something that's going to start to adjust just because we are getting a little bit of a warming as we kick off February on the heating oil side. So that will help pull some of that down. It'll still stay strong, still above the 5-year average, so nothing to be concerned there. Then on the jet fuel side, as we were expecting that drop to about 1.4 million barrels a day. Instead, we had a bigger drop to about 1.278. That's bringing us down 235,000 barrels a day, and we expect that to remain under pressure. Propane dipped a touch, 63,000 barrels a day, still remaining strong. We expect that to remain elevated through this week and then start to pare back as we get into February, just again, based on some of the warming that has happened. Now, on the European gasoline imports, the U.S. is getting a bit more gasoline. We started to see an increase from the low, and we should see that continue through the end of this, into next week as well. Looking at crude oil inventory, we're now above 2018. We should continue to trend higher. You can see the rate of change has been fairly stable versus where we were in both 2018, 2020, as well as 2019. We expect the rate of change to accelerate just a bit, but still stay fairly in line, just moving a little bit closer, just based on that rate of change that we discussed, a little bit closer to 2019 versus 2020 versus where we are in against the 2020 numbers. Now, when we look at crude oil, supply for crude oil still fairly elevated when you look at days of supply, and that's really just because the builds continue. Albeit they're small, but when you look at refinery runs, they continue to pare back, so the amount of crude necessary continues to shrink, which is keeping days of supply fairly elevated. Now, when you look at total U.S. commercial oil storage products, this is where we're looking at when we're looking at oil, gasoline, distillate, residual, and jet fuel. The rate of change continues to move up, but as you can see from the other years, we normally have an increase right now. So as we've been saying, we expect the rate of change to increase a little bit, which is going to put us a bit closer to 2018 numbers. And then eventually we think we're going to get a little bit above that, just based on where crude is and where gasoline is, because diesel will continue to be and distillate will continue to be in the bright spot. Gasoline had a build. You can see the rate of change adjusted a bit. And as we were saying last week, it was either going to happen this week or next week in terms of some of that adjustment, because when you look at some of the other competing years, you typically have a pause, if you will. So here you had a little bit of a pause. We do expect to see the rate of change continue up, and we expect it to peak as we get into the beginning of February. So we do expect one or two more sizable builds before we start to flatline and then go sideways and come down a bit. Some of the things that are going to weigh in on that, which is again going to increase some of the pressure. Our exports remain very slow. We don't see that changing, especially given where demand is in South America. They're facing something similar when you look at some of the demand shortfalls. So Mexican imports of U.S. gasoline have fallen off, and we expect that to continue to be the case, keeping a bit more of that gasoline in storage. On the distillate front, another draw continues to be strong. You can see that normally there are draws. So the rate of change is going to be very important, because when you look at where you're just using 2020 as an example, you can see how aggressive some of the drops were in 2020. And then you had that pivot in March. So the question is going to be, where do we kind of balance out? We expect the draws to continue, but we do expect the rate of change to be a bit softer. So the comps will get a bit easier just given where we kind of shake out. We do expect to be at the lower end against the middle of the pack as we get into March. A little bit of that warm up in February will help, because diesel demand road diesel demand is going to stay strong, going to remain robust. So it's really going to be on the heating oil side that will be able to kind of make up some of those differences. Now on the jet fuel side, again, you have to kind of think of these together when you're looking at distillate as well as jet fuel. A sizable build, just bringing us back into the bottom of the cloud. And remember, they can leave kerosene in the disti cut, they can pull it out. So this is something that they're expecting to refill a little bit, even though we are getting additional cancellations driven by Omicron, as well as some of that slowdown that is a bit more than seasonal, which we'll discuss at the end of segment 2. The crude curve continues to strengthen, especially on the front end. You can see that we're above 80 as we get through pretty much most of 2022. Then we're above 75 as we get into pretty much the beginning, or I should say the middle to end of 23. And then things remain elevated as we go through 24 and beyond. So the curve still remains elevated. You're still seeing a lot of that bid in terms of the time spread between the first and second month. So that's something that we do expect to see a little bit of a cool off, but obviously it's not happening yet. We have the Fed decision coming up in terms of rates. So that could be something that bites into inflation a bit. But given the concerns around the Ukraine, given what has happened with Yemen and the UAE, as we discussed in Insights, that is putting a little bit of that bid on the geopolitical front, keeping things elevated. But when you look at the curve still remains supportive of new projects. So it's going to be something to consider when we think bigger on some of the longevity of the projects that have been delayed over the last few years. Now, when we look at COVID, you can see that net changes around the world still remain elevated. The U.S. is past its peak, but still high. Europe is something similar. UK is kind of leveled off a bit. When you look at India, India, Asia Pacific in general still remain elevated. They're a little bit behind us when you think about timing. So we will see some of that Omicron kick up. We should get one more spike in Asia as well, just because of Lunar New Year. The ease in which Omicron can transfer, because it feels like if you look at someone with COVID, you get it. So again, this is something that we expect to be not so much a huge impact, but something that will pare back a fairly sizable travel season in Asia, but not a huge concern, just given how the impacts of this strains tend to be much lower. So the recoveries will be a little bit faster. So again, still something to watch and keep in the back of your mind, as we do have some additional flight cancellations. On the increase on pad 3, you can see that it's just following a pretty steady rate of change. We expect to be maintain above the right now the 2020 levels. We'll cross above 2019 within a week or two, and it's again, there's not too much to say across. It's seasonally normal to have builds, and we see it being seasonally normal in pad 3 as we go through the next few weeks. Cushing, on the other hand, you can see that it's moving with 2010. If you think about where we've had this dip before, you can see in 2018 we had a sizable drop as well. This is something that we think it'll continue to waffle back and forth. We were expecting to see some draws, just not this type, this elevated amount. So we should get a little bit of a pare back. But this is going to be something to consider when you start looking at WTI, when you're looking at the curve and how the curve is actually pricing itself. Now, when you look at floating storage in the Gulf Coast, it's increasing. We were expecting it to see this increase. We normally get that spike this time of year. Again, it's also to bring in some of that heavier crude, so we do expect this to remain elevated as, again, coming back to the timing of when does it get imported, because imports did take that dip. It fell out of the cloud for on a seasonally adjusted level. We do expect that to spike back up. And we do expect the imports to take out that high from 2022. Again, not getting back to the 5-year average by any means, but at least moving a little bit further into the lower end of the cloud. Pad 2 still remaining strong. We were expecting, based on what we were saying, it was either going to be one more little increase and then a drop. That was what we got. It could have been either way in terms of a little bit of a drop and then an increase. Again, things still remaining strong. We're going to stay well above the 5-year average on when you average out 2022, just because of the new pipeline, the ability to bring down, and then obviously pad 2 refiners still remain the most active, which is going to have to keep imports, especially coming from Canada. Now, when we look at refinery run rates, you can see we're right back into the 29-year average. We expect that to be the case. So again, that steady decline as you get to about 86.5, 87, but not a huge drop. You can see where Uri is, which is that huge drop. You can see where some of those impacts are. Barring weather, as it's always the great unknown. We expect to see activity staying fairly stable. And remember, without Uri, which obviously disrupted a significant amount of refining production. Without that, we should see some things normalize a bit versus where they were in 2021. So that's what we have for you on the global feel and looking at the high level data for the U.S. And now in the next segment, we're going to go deeper into U.S. data, especially on the refined products front.